Last month, a man who spent 30 years building his business asked me a simple question. And the honest answer was a hard one to say out loud. There's a tax bill waiting on the day you die, and it's attached to everything you own, and you've never seen it because it's not printed on any statement you will ever read. And by the end of this video, you will know exactly what the bill is, why it exists, and why no one ever put it in front of you. And you will also know the one move that turns it from a fire sale into a problem you have already solved. My name is Henry Wong. I'm a CPA CA with 20 years in practice. I personally trained over 10,000 CPAs across Canada, and I've worked inside some of the wealthiest families this country has ever produced. I wrote the book, The 7 Structures of Wealth, because how real fortunes are built, protected, and passed on, well, almost nobody talks about it publicly. So picture an owner in his late 50s, 30 years building this thing, runs it clean, knows exactly every number in it, taught himself to invest on the side, and got good at it. He has someone inside the company lined up to buy him out in a few years. So on paper, this is a man who won. This is a guy you want to be. We are sitting there going through how he structured his family's wealth, and I ask him one question. Are you familiar with deemed disposition? Well, then he goes quiet and says it slowly. I've never heard that term before. 30 years of building, and the single rule that decides what his family actually keeps had never once come up. Not from anyone. So I walked him through it the way I am going to walk you through it. Everybody knows Canada has no estate tax, so people hear that and then they relax. Here's what they miss. The code does something else instead. On the day you die, it treats you as if you sold everything you own that day at full value. Your business, your investments, your registered accounts, you didn't sell a thing, but the code says you did. And I want you to slow down right on the business, because that is where it bites the hardest. Say your business is worth a few million. The rules deem it sold on your last day, and a big share of that gain lands as income on one return in 1 year. And here is the part that turns a tax problem into a family emergency. The value is real, but it is locked inside your business. Your business is worth millions, but your bank account probably doesn't have it. So the bill is enormous, and the cash to pay it is not sitting anywhere. Now, I watched it land on his face, and he said it himself, slow. So if I get hit by a bus tomorrow, that bill comes due, and my family has to find that money. Where do they even get it? And I told him, you are now asking the right question, because the default answer is ugly. They sell, and they have to sell fast, whatever will move. And a business whose founder just died doesn't sell for what it was worth the week before. The creditors start calling their loans, the competition circles, and the buyer across the table knows exactly what kind of sale this is. He or she can smell it. So let's step out of the situation for a moment, and let me tell you why this happens, because it is probably not what you think. The person who files your return is scoped to one job: meet the government's deadline, file it on time, file it right. That is the work you hired them for, and most of them do it well. Deemed disposition is not a deadline. It's a triggering event. And the trigger is your death. It lives outside of the filing calendar, and so it lives outside the job. And the ones who have seen it up close are rare, because for any single owner, it happens exactly once. So nobody failed you. It's just that the rule that matters most was never inside anyone's job, and because you did not know to ask, it never came up. What I'm sharing with you is something most owners have never had explained to them. Every year, your financial statements get prepared, and one page gets put in front of it, and it's called a compilation report. Most owners glance right past it, so I want you to read what it actually says. The work was to assemble the numbers you provided. Assemble and file. Not protect, not warn, not look down the road at the day you are gone. And there is a tell in plain sight. A public company in Canada has to show its income taxes right on the balance sheet. the ones due now as well as the ones coming later. Your private company doesn't have to. It's not required to, and often it wasn't worth paying for when your business was small and growing. That was not a mistake, it's a reasonable call. But the number exists for you exactly the same way. Nobody is just required to put it in front of you. So here is the cleanest way to feel it for you. Here's an example that has nothing to do with your business, something you can probably relate to. Say you bought a stock that was $10,000 and today it's worth $100,000. That $90,000 gain does not all get taxed. And you know about half of it currently gets stacked into your income the year you sell. So you are taxed as if you earned far more than you did. You already accepted that when you sell the stock. Deemed disposition does the exact same thing, except it also includes the largest asset you own all at once on a day you didn't pick. And at worst, because there are more layers of tax behind it, just to get the money out of the company, which will be its own video, I'll share that with you as well. Think about how this actually goes. You start the business for the dollar it costs to incorporate. You grind, you scale, you reach a level of stability, and the thing you've built is now worth real money. Then, one day, you exit on your terms, or on the day you are no longer here. On that day, the CRA treats the whole thing as you've sold it, and they use that as a tax basis for everything you built, and that lands on a single year, in a system where the more you make, the more they take. It only gets bigger when you own more than one company or your structure has multiple layers. Taxes are not avoidable, but they can be minimized and managed. And almost no one has looked at the largest one you have, the one sitting inside your business. And as an owner, I would rather know that number today and build my wealth around it. Watching this costs you nothing, knowing that number costs you marginally, but paying for what it costs and when the bill comes when you are gone, a day that no one can put on a calendar, this is the reason you want to look at it now. The bill is certain, the day is not. So you don't beat it by guessing the day, you beat it by making sure you know that the money shows up on whatever day it turns out to be. So the first thing I'm going to share with you is you want to size it. Now you know why it never came up. So here's the one question that puts it on the table. Ask the person who files your return directly. If I died this year, what is the deemed disposition bill across my business, my investments, and my registered accounts? It is a calculation, not a mystery. Most owners have never asked this question because it only happens once and nobody volunteers it. And so this is the one email you can send to fix the conversation with your own professional. The second is to fund it. You decide how it gets paid because there are only three ways. Your family sells under pressure, your family borrows under pressure, or the money is already there on the exact day it is needed, sized to the bill. And the third one is what a tool, a permanent life insurance policy, actually does in this picture. And I will name it plainly because that is one of the best tools and things it does when it is structured properly for liquidity. And the dollars you put in are a fraction of what they cover, and the payout lands tax-free on the day it is needed. You are securing a large, certain liability with a smaller, predictable, tax-efficient outlay. That's not a cost, that's something called leverage. And when it's structured right, it can give you access to liquidity while you are still alive, not only on the day you are gone. The third thing is talking about the bill itself and shrinking it. This is the lever that actually makes the number smaller, and it is also structural work. How the shares are held, where the future growth goes, what the family can claim on a sale. One lever related to that is the lifetime capital gains exemption and making sure your business stays qualified for it. That depends entirely on your numbers, the position that your business is in, and so it belongs to a real personal conversation, not for this video. So you are working two different layers, not one. Shrink the bill through structure and fund whatever is left through leverage. Most people get sold the product without an architecture, or they get handed the architecture without the funding. Usually, you want to fund the certainty first and then engineer the size down. The order can flip, it just depends on your situation. So this week, one thing is asking the size question. One email to the person who files your return. You aren't committing to anything, you are just finding out the number that already exists, whether you look at it or not. So if you've built something worth millions and not one person ever said the words deemed disposition to you, that is exactly what this channel is for. Subscribe. There are 6 more structures where this one came from. Nobody is hiding this rule from you. It is just that the default has already beneficiaries. They are just not your kids. The tax authority and your creditors collect first. The buyer who shows up at the funeral collects second. Your family keeps whatever is left. Unless you choose to intervene and build the structure that interrupts that order first, it's never going to happen. Right now, the whole thing runs because it lives inside of your head. So the question is simple. Does it survive the day you are not in the room, or does it not? You decide that now, or the day decides it for you. I'm Henry Wong, the Wealth Structurist. And remember, no one cares about your wealth more than you do.